Well, some of the numbers in this Motilal Oswal note caught my eye for sure, and I thought it's a good idea to put them out there on the table. So let's take a look. The market's breathtaking rise over the last several months. The question that most of us are then often confronted by is whether valuations are completely full up or can there be more upside. So here are some numbers to map exactly that. Let's start with the first ratio. This is market cap to GDP. We are currently at current FY22 estimates at 104%. That's market cap to GDP. This is, of course, Motilal Oswal estimates. The market's long-term average market cap to GDP ratio over the last 16 odd years is 79%. We are at 104%. So that's something to keep in mind. This is obviously over a 16-year period, FY06 to 21. That's what I'm talking about. In fact, the last time this ratio went above 100%, guess when it was? We're talking 2008. That's when we were again trading at a little over 100%. Now let's look at valuation starting with price to earnings. Where are we right now? We're at about 20.5 times. This is forward earnings, 12-month forward. The 10-year average period for our market, these are NIFTY numbers that I'm talking about, is just under 19 times. Now let's look at price to book. Again, the Nifty is trading higher than its long-term average. We're at 3 times right now, 10-year average 2.6 times. If you look at trailing earnings, then the gap between the current and the average becomes even wider because we are at 26 times, a little over 26 times, trailing 12 months. The average is about 20 odd times. Now let's boil this down to stocks. A little over half of the Nifty constituents are trading above their historic average PE multiples. Let's actually look at some of those companies. The ones that are trading at a significant discount, different reasons, of course. A lot of the technology names, HCL Tech, Divi's, we know, how it's been a huge compounding story. Wipro, Asian Paints, Infosys. You could argue whether this is, a re-rating, a genuine re-rating or something else. That's a debate for a later date. But look at this, and I found these numbers very interesting. Despite the huge run-up in the metals SPAC, Tata Steel is still at a 60% discount to its 10-year average historical PE. So is Coal India, so is ONGC, NTPC, ITC. We all know about ITC, right? Interestingly, if you look at sectors, then what sort of caught my attention was the fact that infrastructure, despite the run-up, is actually at a 62% premium, near 63% premium to the 10-year average. Consumer durables, retail, technology. Now, technology is a big debate, whether this is a genuine valuation upgrade and a total re-rating that's happening thanks to the blowout numbers that we're seeing. And consumers, they've always been obviously trading at a premium. What about banks and NBFCs? No surprises here. Private sector banks, we are above historical averages at 2.8 times. The average was 2.4 over the last decade. PSU banks are trading at the mean, the historic mean. NBFCs are richly valued, 3.2x versus 2.6. Last but not the least, the interesting thing is that if you're looking at the return on equity, that's of course financials, the overall PE that we're talking about, we're at 14.9 versus 13.8. If you look at the overall ROE for the market, this is not actually financials, for the entire market, then this is a silver lining, that in terms of return on equity, the market is doing better than the long-term average.